Okay, we're going to get started with our next panelist. Rowdy crowd today. Okay. Too much See's candy.
Would everyone kindly find their seats? We are going to resume. Thank you.
Okay. Another great insurance company. So, Markel Group is a diversified insurance company headquartered in Richmond, Virginia. As of 1Q24, the firm had $15 billion of equity, total assets of $53 billion. There are 13 million shares outstanding, current price around $1,600, $20 billion market cap. I'm joined by Tom Gayner, who's the CEO of Markel, who joined the firm in 1990.
I'll root for that.
He oversees all the investing activities. He also serves on the boards of Graham Holdings, Coca-Cola, and Markel Group as well. And he graduated from the University of Virginia. We're thrilled to have him here. We had him a couple years ago, and I would just note the firm's strong earnings results a couple days ago. So we're very excited to have Tom today.
Thank you very much.
So, Tom, I'm going to get right into it. Markel generated a very strong year on the investing side. I'm going to try to improve some of the insurance underwriting last year. And we're here this weekend because of our appreciation for the Berkshire and in the insurance model. Maybe you could just remind us why this business is a great one and how Markel has benefited over the long term in terms of some of those dynamics.
Sure. Well, why we are all here, of course, is for Berkshire and the accomplishments they've put on the books for years and decades now. I can remember in 1984, I had gone through my brief tour of duty as a CPA practicing public accounting, and had already decided that I was an accountant who was more interested in dollars than numbers. So probably the path of trying to become a partner at the time a Big 8 firm was not the thing for me. And I went into the investment business at a firm called Davenport & Company in Virginia. And of course, as an early broker and the fear of making calls and talking to people, sometimes you spend your time distracting yourself with other things. So one of the things I was distracting myself was reading Fortune magazine, and Carol Loomis's article about Buffett was in that magazine in 1984. And I read that, and it instantly clicked with me. It just made all the sense in the world. Now, I'm not the smartest guy in the world, as proven by the fact that I didn't buy Berkshire stock immediately upon reading about it, because I thought it was too expensive. And there's a lot of things we can talk about that. But at any rate, that was a brand. It seared into me that here was someone who had taken an insurance business that was committed to making an underwriting profit because they were a specialist rather than a commodity generalist, and taking those pennies of underwriting profit and investing that long term. And that meant both public securities and the ownership of other businesses and controlling interest. So it just made all the sense in the world to me. So in 1986, 2 years later, I'm working at Davenport, and Markel goes public. And luck of the draw, I was the analyst assigned to cover Markel. So I see this, and here I see this very small regional insurance company, probably market cap, I think it was $32 million on day one. But they had a underwriting profitability, which especially at that time was unusual because interest rates were meaningfully higher than they are right now. So industry average combined ratio might have been 105, and nobody thought a thing of it because you could lose 5 cents on every dollar coming in on insurance underwriting, but then you could make 12 or 14 cents on investment income just from interest income. You didn't have to go afield at all to do that. And that created acceptable but not wonderful economic results. Markel always had the disciplines, always got to be better than 100. And for 36 years, I think the average has been 95. So you take that nickel of underwriting profitability and you invest that nickel long term. Well, in starting out with the total market capital of the company being $32 million or so, we've done a couple of acquisitions where we've doubled the size of the company. We've raised money, I think, twice with some a little bit of equity issuance along the way, but not major. And now the market cap is $19–20 billion. The investment portfolio has gone from $30-some million to $30 billion. And it's all based on the architecture that we learned by seeing how Buffett did it at Berkshire and followed basically the same playbook, where we just keep trying to build an insurance business where we bring intellectual capital as well as financial capital. So we earn that right to make an underwriting profit, and we invest those nickels with a long-term horizon and let it compound. And this is an especially fun trip to Omaha this year, because this year, right now, on one security, and when I corrected my error of not having bought Berkshire in 1984, I did buy the first share in 1990. And our holdings of Berkshire stock at Markel right now, that we started buying in 1990, now have an unrealized gain of $1 billion. So we crossed over the $1 billion threshold from hanging out here in Omaha, so we're for it. And then the total equity portfolio, the unrealized gain on that is now up to $7 billion, compared to a $30-some million start without raising a lot of money. That's the power of compounding when you do it over 30-some years. And again, learning from Buffett as the teacher, which is one of his fundamental roles, the tax code, at least for now, doesn't tax unrealized gains. So that's $7 billion of unrealized gain, in essence, at current tax rate, provides us with $1.5 billion of interest-free, zero interest cost capital in our capital stack. So, making money with money you borrow is one thing. Making money on money you borrow, which in essence we were doing, which has a 0% interest rate with it, that's easier. So it is an advantage that builds upon itself over time. And I would guess, and I would love for the investment professionals in this room to let me know where I've missed something, but Berkshire has an epically large unrealized gain on its portfolio for all the reasons we just talked about. Ours is now $7 billion, as we mentioned. Tell me who else has one that's bigger than $1 billion. It's just not done very much. So I'd love to know who else is kind of running the same playbook that has that kind of unrealized gain on the books.
I think we looked at Berkshire's as like $93 billion. I mean,
that would be more than, yeah.
It's extraordinary. All right, so sticking with insurance here, and I understand kind of the complexity of the whole insurance market, and but we also are addressing a crowd of less informed investors today. I understand the Berkshire model, but maybe you could just talk a little bit about what's going on in the reinsurance market a little bit. Where are we in terms of what industry professionals call the hard market, and factors that may determine pricing in the next couple of years? And again, part of this understanding is to understand what we'll hear from Ajit tomorrow and what they're doing as well. So maybe just a little more background on that for us.
Sure. Well, I think this would apply both to the reinsurance and insurance markets. They really do travel, maybe a little bit of sine wave, but they travel together. So I've been at Markel 34 years now, and I would say that we have been in a soft market in 37 out of those 34 years. People joke about hard and soft market. People tend to worry about soft market and pricing, and that's an important short-term dynamic. But in general, soft market where it's competitive and it's hard for the insurance company to operate and make an underwriting profit, that is the case for the vast, vast, vast majority of the time. There are certain episodes in the wake of the World Trade Center, in the wake of Katrina, Rita, Wilma, and that hurricanes, which I think was 2005. And in the current environment, which I think COVID has a lot to do with, it is a little bit easier, not easy, but easier to make that underwriting profit right now. And oftentimes people would describe that as a hard market, meaning that in the balance of power negotiations between the client and the insurer, primary or re, the balance of power is a little bit in the hands of the insurance side right now. but that's, it's pretty logical and easy to understand when, I mean, think about anything you're buying right now and the degree of inflation that's out there. So if if we are insuring something and something bad happens to it, any data that we had as to what the construction costs were, or what the judicial verdicts used to be, or what the professional fees involved were in getting something done, 99 times out of 100, those costs to do that now are higher. So insurance is just a pass-through mechanism. In and of itself, all we're doing is pooling the entire cost of the system and then parceling that out into bite-sized pieces for individual customers one at a time. So it is not surprising to me that within the context of inflation writ large, insurance prices are going up because they kind of have to.
So there's an element to inflation being a positive
Yeah,
to some extent in terms of the asset prices and the insurance. But as you say, it's a pass-through.
Well, my great friend Shad Rowe, who's a wonderful investor, and I would encourage you to read anything you can find that he's written. He says, at any given point in time, well, he says, a pancake, no matter how thin, has two sides. So the pancake of inflation has two sides. There are things that are troubling and challenging, but there are also things that are good about it. So if you're asking me as a citizen, am I in favor of inflation or not? I'm against it. If you're asking me as an insurance company executive, I'm against it. Inflation is not a good thing. That is a sign of bad political circumstances. So we would be well served, all of us, despite whatever narrow political interests we would have at any given point in time, to have less inflation rather than more of it, in my opinion.
So another element to inflation is social inflation. And again, for the uninformed, this has become a bigger component of the insurance business in understanding actuarial. And maybe you could just talk about what it is. Why do we care as investors? And how is Markel thinking about some of these elements in their underwriting?
Well, again, thinking about COVID and the circumstances and whatnot and some of the unmeasured impacts of it, I tell people, what is a synonym? I'm going to ask you this question. What's a synonym for mental health? I won't leave you hanging. Health. Health.
Okay.
Mental health is an important component of health. It would be a false distinction to talk about mental health and think that that is separate and distinct from health. It's part of it. So inflation and social inflation are two different terms, but they're the same thing. Social inflation is just trying to describe some aspects of inflation writ large. And the way it would show up in the insurance world in particular is, let's just say, at 10 years ago, a certain thing happened and somebody sued somebody for the injury or defamation or whatever, and the judges in that area and the judges in this state or that state kind of put a price tag on what that kind of claim was worth. And if we go back 25 years ago, maybe that was $100,000. And then one day we kind of woke up and it seemed to go to $500,000. And then it went to $1 million. And then it went to $5 million, and then it went to $10 million. So there's judicial verdict sort of price tags just because of a change in the sense of things. That's what I mean by social inflation. That's what that term refers to. In the workers' compensation world, one of the things that happen over time is, again, somebody's working at a job, some injury happens at the job, so somebody loses a finger or loses an arm or whatever. Basically, the workers' comp system was created and designed by government, regulatory agencies, things of that nature, in order to put a fixed price on it. So you didn't have to litigate every single time as to what the value of a specific injury was. It was scheduled out. Mm-hmm. And those numbers change over time, but that is where the effects of sort of the value of human life and aspects of human life is codified. There's a lot in where it's not codified, and there's jury by jury, judge by judge, but you get a sense and a trend of it, and that's social inflation. Insurance jargon would also just call that loss trend, that losses used to cost X, now they cost 1.2 times X. That's what that means. And that factors into why people are describing the current market as a hard market, is that insurers are recognizing that if it used to cost X, we need to price that by the time we pay that loss, it's going to be 1.2X, even though that loss hasn't happened yet, and even though we haven't paid it yet, we do have to think 6 months, a year, 2 years, 5 years in advance for what that's going to be. Another aspect of social inflation is, I grew up, I sometimes call it East Philly. So South Jersey, right across the river from Wilmington, Delaware.
I'm sorry for your loss.
Yeah, well, I moved.
Well, no, last night.
But I grew up within the shadow of the DuPont company. And think about this. I think any serious student of business, one of the things you should study and have some familiarity with is the DuPont company. So I went to the University of Virginia and Thomas Jefferson. And Thomas Jefferson used to dine with E.I. DuPont himself. They were friends. So the DuPont company lasted in glory for 200 years. And not many institutions do that. So you really ought to study and learn that. And they were in some ways, in the glory days of the 50s and 60s, the Google of their day. And the advertising tagline was better living through chemistry. So they were the cutting edge of technology. Imagine Wilmington, Delaware being cool. It's not now, but at one point in time it was. But think of what we read now and see judicial verdicts on forever chemicals. Those were life-changing, cool, new edge, making life better through chemistry things at the time. But now, 50 years later, those very same companies who came up with that, DuPont as an example, are dealing with the legacy burdens of that sort of stuff. That's a form of social inflation because we used to be willing as a society to absorb a certain amount of pollution in order to make economic progress. And everybody priced that to some degree, implicitly or explicitly. And the border and the boundary of what we were willing to do and the prices we attached changed. So we behaved differently, and the amount of pollution has gone down very dramatically because for environmental reasons, quality of life reasons, we've decided we were willing to pay more to not have pollution. Well, those costs are social inflation. And the other thing I think you should do as a thoughtful investor is, I think you should look and think very carefully about what people are doing right now, what things people are involved in right now that 20, 30, 50 years from now, people are going to look back and judge the people of now by the standards of tomorrow. And they will do that. And as a consequence, that trend line is up. There's another aspect of social inflation. Last story I'll tell about that, and again, I went to UVA and loved UVA and involved in all kinds of things there. Well, for a long time, the main library was called Alderman Library, and Alderman was the first president that UVA had in 100 years ago, whatever. So there are certain things that Alderman did and he was involved with that by the standards of today, that's not acceptable. So Alderman Library was recently redone, and the name Alderman was dropped, and it was now called Shannon Library. It was later president. Well, I happened to run into Jim Ryan, who's the president of the University of Virginia now. And it took every fiber of my being not to ask him this question. I'm guessing he's going to hear about it because I'm saying it publicly, but at least I didn't have to ask him directly. I kind of impishly wondered, hey, President Ryan, what are you doing right now that 50 years from now you're going to be canceled on account of? I don't know, but I'd be willing to bet that might very well happen. That is yet another example of social inflation. And I'm not saying it's right or wrong or making any judgment about it, but anybody who's making decisions about the future, which you as investors are, and if you have time horizons beyond a quarter or two, these are the kinds of things that you should factor into your thinking.
No.
Might have gone beyond what you asked me.
No.
Might have gotten more than you asked for, but that's some thoughts.
Well, there's certainly going to be a lot of talk about litigation tomorrow, I would imagine. Technology. Can we talk about some of the elements that, your firm's innovating on, but also employing in some of your risk management. And, we've heard a lot about AI and the progression of that, and we've heard some insurance companies in terms of, your large data sets and actuarial, and maybe you could just talk about where you're implementing technology for clients, but also risk management, and, how do you see this AI wave that we might be seeing impact your business as well?
Well, a lot of components to that. So one, as a habit and as a discipline, as a suggestion, when I hear people use the word technology, I say, how about you just say business instead of technology? Let's not use that word. Technology is so fundamental to running and operating a business that to draw a distinction between what you need to do to keep a business open and running and provide for a future and embracing and using any and every tool of technology that's out there, that's a false and silly distinction. So let's just say business instead of technology, and we fully embrace all of the tools of technology. Sometimes other people get ahead of us, sometimes we get ahead of other people, but that's an ongoing race, and any successful business is always converging on whatever it is that is state of the art right now. If you fall behind too far, you've made yourself obsolete, and I'm paranoid about not getting too far behind and making ourselves obsolete. And so I'm very open and receptive to all the things that technology brings, point number one. Point number two, any technology, no matter what we're talking about, gets better, faster, and cheaper over time. And I think that makes it more approachable for entrepreneurs, for startup firms, for mid-sized firms. You don't necessarily need to be the titan in order to be the master of technology. Now, some positions, being the biggest is helpful, and that's true, and I think we are large enough to be able to be beneficiaries of much of that. But at the same time, sometimes being the biggest and being able to use all the tools, it creates a mindset of satisfaction that can grow into arrogance and stiffness, and that's where the entrepreneurs can find their opportunities and come up at you. And then, again, I know the air and the zeitgeist is filled with AI, and that's the phrase. Well, I remember crypto or biotech. I've been in this business long enough to know phrases, and all of them are true, but they tend to get emotionally invested with more meaning than perhaps they have. And as an illustration of this, I have a 4-year-old grandson, and he was over at the house Masters weekend. And we had the Masters on, of course. And he was happily playing and building stuff with his blocks and whatnot. And for any of you who are golfers or watch the Masters, and you know the serene soundtrack and the limited commercials and just the whole setting and the way in which the Masters takes place. And so there were the limited set of commercials, and there my grandson was playing with his toys, and at one point he said, AI, 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 AI. So we don't wish to operate at the level of a 4-year-old. When it has become so pervasive that he says it like that, let's take the emotional dial down from 11 a little bit. But at the same time, you're an idiot if you ignore it and all of its implications. So it's in a rational, thoughtful way. Figure it out. Don't hide from it. Don't put your head in the sand. Figure it out and use it as an appropriate tool for how business gets done.
So you're in charge of capital allocation for Markel, and you have a captive operating businesses that you absorb, but it's been pretty quiet over the last year or so. Maybe you could talk about the opportunity set you see in terms of your pipeline. How is this kind of higher cost of capital helped or hurt you potentially for acquiring companies? And then maybe you could just talk a little bit about competition. I assume there'd be private equity or other participants that would be looking to buy operating companies as well.
Right. Well, that's again a perfect illustration. One of the a pancake having two sides. So a couple of years ago, I believe it was the 50th anniversary meeting out here, and Charlie was with us at that time, and it was a milestone meeting because you could see so many things on the way. But at one point, in response to a question about how did you do this, how Charlie made the point about rational decisions and the compounding effect of just making one rational decision after another. And he said, when we started this business, we were two guys with a phone. And now we're bigger than GE. That should not have happened. That's a direct quote from what Charlie said at that meeting. So, rational decisions, one after the other, after the other, after the other, after the other. That is what Charlie ascribed the size and scale and breadth and depth of Berkshire to, being done and executed faithfully over 50-some years. We've not been at it as long. Those guys are smarter than I am, but we do try to make rational decisions. And one of the beautiful pieces of the architecture of the Markel Group is that we have a 360-degree range of capital allocation choices. We can either invest in our existing businesses, fund growth initiatives. We can buy a new business. We can put money in public securities portfolios, both fixed income and equities, or we can repurchase our own shares. And we have done every single one of those things in meaningful ways at different points of time, depending on where things looked the best. As Charlie used to say, when somebody said, this is a great deal, he would say, compared to what? So we have an internal mechanism to compare any new things that comes into the transom to all the stuff we already have, including our own stock. So the first Markel Ventures deal we did, and that's what we call the non-insurance operating businesses, was in 2005. So go back in your mind and time travel to what the environment was like in 2005. The economy was going well, it was all good, but it was a normal kind of year. Interest rates, I don't remember what they were, but it's just normal. And the AMF deal happened to be very idiosyncratic in that I happened to personally know the CEO. So we were able to do something. And in fact, when we bought that, he said, when I proposed buying the company, he says, I didn't know you did things like that. And I said, well, we don't, but we might. So that's how we bought AMF. And that really raised a flag that Markel was indeed interested and willing to buy things other than just insurance companies. So a lot of conversations started to ensue. But for 2006 and 2007, we were in a bull market, prices were going up, things were rocking and rolling, and the bid-ask spread between what I thought a business was worth and what they were able to sell it for in the marketplace widened such that people really didn't return my calls. And it wasn't until 2008, when the financial crisis hit, that people thought, hey, somebody whose check is going to clear? Yeah, I'll talk to you. So we were able to do a sort of a bunch of deals in 08, 09, 010 because pricing was very favorable, and it laid the base layer and the foundation of our Markel Ventures businesses. And then, I don't know, starting in 2016, 2017, observing private equity, observing the bids and everything, I kept saying, these prices are starting to get too high, so in making rational decisions, I don't want to make any promises that we're going to buy anything this year because prices just seem too high, and we have other things to do, so don't worry about it, but I wouldn't expect it. And 2018, 2019, 2020, 2021, we had deals that came through inbound traffic of people who we knew, one degree of separation kind of stuff, very unique family circumstances that were involved, such that it was not going to go into a private equity kind of process, such that we were able to continue to make acquisitions of new companies. Now, that finally really got to the breaking point in 21, 22, so we didn't buy anything for a while, and that's where we are right now in terms of a new company. But the good news is that because we have 19 different operating businesses, the CEOs of those businesses know people in their industry that I don't know. Mm-hmm. And they have been able to buy additional businesses within their field. So it doesn't look like a new acquisition to Markel, but it is a new acquisition at the operating company level. And we've done that at some level for the last year or so. Given that interest rates have started to go up, the amount of inbound traffic we are getting has increased, but I don't want to set any false expectations. It's still, I am surprised at the prices people are still getting in many instances, but it's kind of trending our way. And the higher the interest rates go, the more favorable our hand becomes. So we're a little counter-cyclical in that way.
Well, Tom, I think we've reached our time. Thank you for being here today.
Thank you.
And on behalf of Gabelli Funds, it's a pleasure to have you. And we're going to take a small break, and then we will be back for the next panel. Thank you. Thank you, Tom.